Hello again, everybody. Dr. Richard Smith here with the Foundation for the Study of Cycles and Cycles TV. And good to be with you again this week. And going to continue, probably wrap up the conversation that we started last week, looking at Dalio's debt cycles. And really, it's a whole thread that I've been working on, I'd say, for a few months now, including my presentation at the Market Summit on staying alive in 2025, the work that Lars von Tienen did with Michael Howell and his interview, and then I followed that up with a piece on global liquidity cycles and biological cycles. And so I want to tie together now the Dalio debt cycles, the Howell global liquidity cycles, the picture of cycles from my efforts to forecast 2025, what's going on in the current administration and in the US financial and global financial system in general, to really try to get a picture that we can work with. And as I said last time, there is no higher purpose for the Foundation for the Study of Cycles than helping us all to use cycles to help us navigate our world. And I do think that we are in a crisis at the moment. And the cycles, we're at a cycle peak in terms of, or a cycle trough in terms of interest rates. Lots of cycle peaks in terms of the real estate cycle, the 41-month cycle. So clearly we got headwinds and we're in a difficult financial position. So we can't be head in the sand about that. We can't be, ostriches, okay? And how can we use cycles to help us not only predict what's going to happen, but I never have understood cycles as being something that we are just passive observers of, or that are just for us to make sure that we can make money in the markets. No, we are active participants in our world, and we're active participants in the unfolding of the cycles. So we have an obligation to try to understand what's going on, integrate our knowledge of cycles, and come up with some solutions, or at least what we think needs to happen so we can respond to that. So going to pick up where I left off last week, probably going to be a little longer today like it was last week. I was pleasantly surprised that there was as much support and interest for something that admittedly is tough to really make sense of. So with that as preamble, let's pick up where we left off last week and take it a little further. So here we go. All right, I guess I have to share my screen. All right, so this is where we left off last week, and I will have mercy on our eyes here. We talked about Dalio's debt cycle. We reviewed the interview of Tucker Carlson, or of Ray Dalio by Tucker Carlson, where Dalio was talking about the need for a deficit reduction and ultimately a debt to GDP reduction, wanting to get it down to 3% instead of its 7.5% ish, where it is right now in terms of the deficit to GDP. Deficit to GDP is not the same as debt to GDP. But our deficit is how much we're adding to the debt each year. So I think it was like 1.8 trillion, 7.5% of GDP. And Dalio said, we need to get that down to 3% in the next few years. Meanwhile, The only other time that happened was, I think, 92 to 97. And the economy was a lot healthier back then. Didn't have the debt levels that we have today. So it's harder to make dramatic cuts in spending or increases in tax revenue in a short period of time. And so we kind of arrived at the idea that, that is what we need to do. We need revenue, tax revenue growth. We need spending cuts. We need interest rates to stay stable or even to come down because the cost of servicing our debt. Speaking of which, there was an article this week by Niall Ferguson on debt has always been the ruin of great powers. Is the U.S. next? And he put forth something that he calls Ferguson's Law. But great empires, great powers decline when the amount spent on debt servicing overtakes the amount spent on national defense. And the U.S. has crossed that threshold back here in 2023, I guess. And this is a projection out forward. If we don't get, interest rates and debt under control, then our servicing of the debt is going to cost more and more, eclipse our defense spending, and ultimately, as he says, after which the centripetal forces of the aggregate debt burden tend to pull apart the geopolitical grip of a great power, leaving it vulnerable to military challenge. The United States still has a couple of oceans between us and the rest of the world. But it's a serious issue, and we're definitely there. And we need to be thinking about how do we make sure this doesn't get worse and, really happen. All right, so we talked about a more realistic cardiac rehab approach where phase one, stabilize the economy while slowing debt growth, like maybe bring the deficit down by a couple of percentage points. Phase two, implement gradual spending reforms and revenue increases to bring the deficit toward 4%. Phase three, if economy remains strong, finish the job, bring deficit to 3% or below sustainably. So I do think that we have to be realistic about where we are. I do think that, look, I'm not in charge of the U.S. government. I'm just trying to make sense of things myself. What's a realistic plan given where we are and what we can understand today? The slower, controlled approach avoids shocking the economy into recession, gives policymakers room to adjust if growth slows or interest rates spike, and maintains investor confidence without overcorrecting too quickly. We also looked at a couple of historical examples, all via ChatGPT, and key takeaways for the United States today. Sustainable and inclusive economic growth is crucial. We got to work together for increasing GDP and reducing debt to GDP ratio. We need economic growth. We need tax revenue, not necessarily higher taxes, higher tax revenue, and inclusive economic growth. That's a big deal. Fiscal reforms, comprehensive tax reforms, and prudent spending are essential. All these things are essential. Political consensus, that's a tough one right now, right? But I think if we all start to look at what the picture really is, we all have a lot of mutual interest in making sure that this picture gets under control. And structural reforms addressing long-term liabilities, such as entitlement programs, can help manage future debt. All right, so that's kind of where we ended last week. So this week, I started a new thread. I want to examine U.S. credit markets in light of Dalio's debt cycles DDCs, and Michael Howell's global liquidity flows, or GLFs. Michael Howell talks about GLFs in his Substack, Capital Wars. In a recent interview, Howell talked about 4 big drivers: the U.S. Fed, the People's Bank of China, bond market volatility via the MOVE Index, and U.S. dollar exchange rates. Said the main thing going on in the West today in capital markets is debt refinancing, and that you need a good balance sheet in order to refinance debt. So that to me is a huge point, right? Like the West isn't that involved in capital investments at this point. Really, most of our capital markets are dedicated to refinancing debt. That by and of itself is, I find it a pretty compelling and persuasive argument, but it's really kind of a devastating argument. But I do think it's one that we have to really be paying attention to, and it unfortunately makes a lot of sense, right? We're not really building things. We're mostly financing things and maintaining those liquidity flows, those capital flows, in order to do the financing and to roll over the debt, right? We have like $7 trillion of debt to roll over in the next 12 months. So you need a good balance sheet if you're going to be able to roll over your debt. And those global liquidity flows, per Michael Howell, that is basically the equivalent of a good balance sheet in this, over financialized world that we're living in. So I'm not going to, read all this line for line, but I just wanted to give you the gist, because we are going to get to some summaries of all this as we progress. So in summary, the interplay between debt cycles and global liquidity flows is crucial in understanding the current state of U.S. credit markets. Policymakers and financial institutions must carefully monitor these dynamics to navigate potential challenges associated with debt refinancing and to maintain economic stability. All right, now let's take a look at it in terms of these conclusions from an earlier conversation about Dalio's debt cycles. So we brought in kind of the conclusions from last time, and the U.S. is walking a tightrope between high debt levels and slowing growth, with global liquidity flows adding complexity. While Dalio's framework highlights the need for growth and reform, Howell's liquidity perspective shows the immediate refinancing risks, right? The lack of political consensus and an increasingly volatile bond market could accelerate a debt crisis unless liquidity conditions ease or real growth improves. We also recently discussed the idea that the U.S. economy could be metaphorically compared to a patient with late-stage heart disease, and that instead of reducing debt to GDP very quickly, we should consider doing it more gradually. We reasoned as such. We've already reviewed that. Integrating Dalio's debt cycles and Howell's global liquidity flows into our earlier late-stage heart disease analogy helps refine how we think about U.S. credit markets and debt stabilization. Refinancing crisis and the risk of a heart attack, right? Howell's view: the current debt cycle in Western economies is about debt refinancing, not new credit expansion. The ability to refinance depends on balance sheet strength and global liquidity. Dalio's view: if debt burdens become too large without corresponding GDP growth, economies risk a disorderly deleveraging, also known as a financial crisis. The U.S. isn't in a sudden heart attack yet, but it's on multiple medications, monetary stimulus, deficit spending to stay functional. Pretty good, chat. If debt refinancing becomes too difficult due to liquidity constraints or bond market volatility, a heart attack scenario, credit freeze, systemic crisis is possible. So revisiting the 6 to 10 year recovery plan instead of the 3-year plan. Key risks of global liquidity shocks, political uncertainty, bond market volatility. Now we're going to get into looking at how a knowledge of cycles can help us navigate a difficult situation, some stormy seas, right? So Howell talks about a 65-month cycle in global liquidity flows. And just to refresh our memories, this is the chart that Michael Howell shared on Cycles TV with Lars von Tienen. Thank you, gentlemen. And the global liquidity cycle here is the dashed 65-month cycle, which he just plotted onto this chart in the year 2000. Okay, back here. Let's see. It looks like a 65-month cycle there. Boom, boom. And I mean, I'm pretty sure that's what he said. And so this dashed orange line has predicted, forecasted, these moves in global liquidity, which is, what's the Federal Reserve doing? What's the People's Bank of China doing? What's bond volatility doing? And what's the US dollar doing? And suggesting that we still have some room in this current upswing of the liquidity cycle, peaking in when? Early 2026. Oh yeah, what else peaks in early 2026? The 18.6-year real estate cycle. Talked about this multiple times. Okay, so you've got a couple indications from the cycles world that we've got some liquidity constraints coming up, most likely in 2026. So how do we use that knowledge to say, well, you know what? We need liquidity right now, right? We need those flows to be happening so that this rebalancing can be happening, refinancing, can be happening while we work this patient off of, out of late stage heart disease into some kind of sustainable trajectory. So integrating that into what we've learned from Ray Dalio, what we've learned from Michael Howell. If Howell's 65-month global liquidity cycle is accurate and liquidity is set to rise before declining, this means we have a narrow refinancing window before the conditions tighten. When combined with Dalio's debt cycle framework, this insight suggests that timing is critical for managing debt sustainability. Okay. How to use cycle knowledge to manage the crisis. By integrating Howell's liquidity cycles and Dalio's debt cycles, we can develop a strategic approach for fiscal and monetary policy makers. Immediate action: use the liquidity window for debt refinancing. Okay, that isn't just the US government, it's probably households too, might even be you and me. Good time to do some debt refinancing while the liquidity window still is open. If global liquidity is set to rise in early 2026, this is the best time for governments and corporations and households to lock in lower rates, refinance existing debts, and term out liabilities. We want our liabilities to be further out into the future, right? Scott Bessent recently said, no, I'm going to keep doing short-term. The Treasury is going to keep doing short-term maturities instead of longer-term maturities. Somebody should tell Scott Bessent about the 65-month liquidity cycle and the 18.6-year real estate cycle, and let him know that very likely there is a more limited refinancing window to term out those liabilities. The Fed may need to pause QT or use targeted liquidity injections to facilitate smooth refinancing, right? QT, quantitative tightening, reducing their balance sheet. Okay. Howell's liquidity cycles tell us that 2024 to 2026 is the last real chance to restructure debt before conditions tighten. So I do think that is true. Dalio's debt cycles warn that failure to act soon will result in a disorderly deleveraging later. Yep, that's great. Thanks. Now I'd like to pivot to something related but different. There's been talk recently of a Mar-a-Lago Accord by Jim Bianco. What is that, and how does it relate to the debt and liquidity issues we're talking about here? So this week, you probably saw in the news some mention of the Mar-a-Lago Accord. It's not a real accord, okay? There has been no meeting. Somebody, I think his name is Stephen Marin, coined the term, and Jim Bianco picked it up and was talking to his clients about it, and it started to make the rounds. Boy, memes, right? The Mar-a-Lago Accord. But look, it is something we're thinking about, and I think somebody in Trump's orbit even, might have floated the idea, right? A speculative proposal reminiscent of the 1985 Plaza Accord, aiming to address economic imbalances by devaluing the US dollar. So devaluing the US dollar would increase liquidity flows, because if the dollar is, going up relative to other currencies, it's harder to service dollar denominated debt for all of those debt holders out there, the other central banks, emerging markets, et cetera. If the dollar keeps going up, it's more expensive for them to service their debt. So in order to, the US dollar, as Michael Howell told us, the US dollar exchange rate is one of the drivers of global liquidity flows. So a lower dollar, okay, a cheaper dollar, is actually increasing global liquidity flows, and is in the interest of being able to refinance these debts. And we're not the only ones that are highly indebted, right? There is a common indebtedness around the globe and a mutual interest in dealing with the indebtedness. And so there could be some opportunity for some kind of accord. I think there's a famous saying, some people attribute it to Keynes, that if I owe the bank $100, it's my problem. If I owe the bank $100 million, it's the bank's problem, right? So the U.S. owes trillions. That's a big problem, and it's not just the U.S.'s problem. So the Mar-a-Lago Accord is not a real thing. It's a total speculation, but it is pointing in this direction of the idea of debt restructuring. Somebody on this show last week in the comments was talking about a debt to equity swap. That's another form of debt restructuring. So I think it's likely in the next 4 years, we will see some form of debt restructuring. In this case, it was foreign holders of U.S. Treasury securities might be encouraged or compelled to exchange their holdings for ultra long-term bonds, such as 100-year non-tradable zero coupon bonds. A coordinated effort to weaken the U.S. dollar would make American goods more competitive internationally, potentially narrowing the trade deficit. Certainly would increase liquidity flows. So that was interesting. It is worth just looking into it a little bit. Again, it's really on this theme of eventual debt restructuring, because 2025, I think, is a so-called Jubilee year. I'm not sure if it's in the Jewish tradition or the Christian tradition, but Jubilee years are when you basically have debt restructuring. And, we don't practice that anymore, but it does kind of inevitably impose itself upon us. So I thought that was an interesting thing that arose this week in the conversation. Debt to equity swap. I didn't know what this was last week. I looked into it a little bit this week. Converting debt into ownership stakes in a company, right? Some kind of interest in the equity of the United States. All right. So while the Mar-a-Lago Accord isn't a direct debt to equity swap, it functions similarly by shifting the burden from the debtor, the U.S. government, onto creditors via devaluation and restructuring. It effectively reduces the value of debt, much like an equity conversion dilutes prior shareholders in a corporate restructuring. If foreign debt holders were offered real assets or revenue streams in return, then it would closely resemble a formal debt to equity swap. Would foreign debt holders ever agree to such a thing? Foreign debt holders would not voluntarily agree to a Mar-a-Lago Accord style restructuring unless they were either forced by market realities, coerced through economic leverage, right? See a lot of that going on right now, incentivized with some form of compensation, higher future returns, access to U.S. assets, or geopolitical trade-offs. A Mar-a-Lago Accord would likely only happen if the U.S. had no other choice, meaning a debt crisis was already unavoidable and policymakers had to manage the fallout rather than prevent it. Right? In that scenario, foreign creditors would be forced to negotiate, much like Japan and Germany had to accept dollar devaluations in the 1980s. All right, carrying on. So I asked it to do a couple of summaries. I went through a couple iterations of this, so I'm just going to move down the list here a bit more. And by the way, for those of you who use ChatGPT, all of what I did so far up here, I used ChatGPT 4.0, but when I wanted to, please review this entire thread and suggest a policy strategy for managing U.S. debt in light of global liquidity flows and cycles where global financial stability is maintained. For that, I jumped over and I used O3 Mini, which is a so-called agentic reasoning version of ChatGPT, right? It goes through a reasoning process and shares its reasoning with you and goes through some iterative steps to try to process all the information a little better than if you just use 4.0. So I went through a few iterations of this. We can skip down to, I think, the final one. Go down to the bottom. All right. So summing up. And I asked it to present it at a 12th grade level and give us some bullet points. So the big picture. U.S. debt, global liquidity, and market dynamics. Massive U.S. debt. The government owes trillions, and this growing debt is a key challenge. Global liquidity. The ease with which money moves around the world affects borrowing costs and market stability, and critically, the ability to refinance our debts. The U.S. has to refinance $7 trillion of debt this year. Right? And to refinance debt, you have to have a good balance sheet. And these global liquidity flows are effectively the U.S. balance sheet in a U.S. dollar dominated world. We know long-term cycles showing unchecked debt eventually leads to a crisis. And we know we're in the tough part of the debt cycle, not the easy part. We know there's approximately 65-month cycles indicate when money is easy or hard to borrow with a favorable window until early 2026. We know that debt rollover is the main function of the Western capital markets right now. Based on our knowledge of cycles, we know there's a kind of narrow refinancing window, as supported by the global liquidity flows and the real estate cycle, both peaking in 2026. Good time to make some smart moves with debt. We know we need to increase tax revenue, cut spending, and stabilize interest rates. Okay, those are the imperatives to stabilize the debt crisis. we're pretty sure that based on the current condition of the patient, that we need to do this in a gradual way and not in a big shock way. Maybe get GDP down, the deficit down to 5% of GDP over the next couple of years. Then, spending cuts and tax increases, get it down a little further. Work towards a sustainable deficit below 3% of GDP. I think that's a reasonable plan. And I think that I know there's a lot of chaos and a lot of storm at the moment. I really hope from a policy perspective, things will settle down. We'll all come to some consensus that these are serious times and we have serious issues that we need to work on together, and that the condition of things isn't as optimal as it might otherwise be, and that we have a lot of shared goals that we need to work on together over the next, let's say, 6 to 10 years. The role of economic and real estate cycles. Dalio and Howell's cycles underscore the importance of timing policy actions to avoid crisis. A real estate downturn would lower collateral values and add extra pressure on global liquidity. Some kind of debt restructuring may be on the table. It's not imminent, especially if they capitalize on the refinancing window over the next 12 to 24 months. Niall Ferguson's observation on national decline, debt servicing exceeds spending on defense. That's happened multiple times. I do think it's not an inevitability, but it is a shot across the bow. And it is something that just tells me more that we need to really focus on lowering our debt servicing costs. As chat notes, this imbalance underscores the urgency for fiscal reforms to preserve national strength. Absolutely. Finally, I said, well, let's say, that these policy ideas are followed. What's the implication for different asset classes? Equities, mixed effects. Higher taxes may reduce profit margins, but improved fiscal stability and strong balance sheets can boost long-term confidence. Absolutely. Defensive sectors may perform better during adjustment periods. Growth sectors may benefit if stability returns. I think we're seeing little inklings of that right now. Government debt, U.S. Treasuries, current liquidity window allows issuance of long-term low-yield bonds. And by the way, just going back to my table from Staying Alive in 2025, I see unemployment coming down, going up, right? I don't think inflation is going to get out of control, although I think we have a little window here right now where issues are in doubt. But a strong dollar is still kind of the expectation over the course of the year. Equities, meh. I'm not saying the bottom's about to fall out, but I'm not excited about equities. But I do think here with 2 years, 5 years, 10 years, this supports the idea that there is this refinancing window that we could get some rate relief. And we certainly have been getting that over the past few weeks, even. Say what you will about Donald Trump, but he does have some leverage. So corporate debt, better terms for the strong. Companies with robust balance sheets can refinance at lower rates. Commodities, successful fiscal reforms could keep inflation in check. moderating price spikes. That would be nice. Contraction in liquidity after 2026 might reduce speculative demand, potentially lowering commodity prices. Cryptocurrencies. If traditional assets face uncertainty, some investors may turn to crypto as a store of value. I think that's going on. But crypto markets are highly sensitive to liquidity changes and regulatory shifts, making them more volatile during economic transitions. Absolutely. Final takeaways. Timing is critical. Act before the liquidity window closes, early 2026, to refinance debt at favorable rates. One thing for all of us, we do not want to be in a floating rate debt situation over the next 10 to 20 years. That's one thing that for myself, I absolutely wanted to get rid of that risk for me. And I think we need to get rid of that risk at a national level and at a global level too. Balance sheet strength is key, right? The capacity to roll over debt is more important than ever. Strong balance sheets across the economy are a must. It's a great point. Increasing tax revenue, cutting spending, and stabilizing interest rates are non-negotiable steps. Look, people, this is what we have to do. Period. Full stop. Cycle awareness. Love this part. Use both long-term and short-term cycles, debt, liquidity, real estate, to guide policy timing and actions. Address the dangerous imbalance where debt servicing crowds out defense spending to ensure long-term national security. Equities, government and corporate debt, commodities, and cryptocurrencies will all feel these policy shifts differently, with transitional volatility expected, but potential long-term stability if reforms succeed. All right. Let's see what's on your mind. Love the international crowd. India, Germany, Dublin. I see Andrea is having some streaming issues. Bruno, are you selling your national parks? I think that it's not off the table as debt equity swap. Very impressive lecture. Thanks. Well, hopefully I've given us some things to think about. I do think it's very important, that we have a framework and that we share a knowledge of cycles, our knowledge of cycles, because it is an influence, a factor in how we navigate this difficult situation that we're all in together. That's the most encouraging thing to me. We are all in this together. People do have common sense in the end, we don't want collapse. But it is a serious time, and I think you'd have to be blind not to see it. So with all that, we need to continue to look at how we lower the debt, especially the debt to GDP, how we up the GDP. And I think that Dalio's insights on debt cycles and Michael Howell's insights on global liquidity flows can be a big help to us in getting a picture here. And hopefully a help to others too. So Franz, is Lars on holiday? Lars is on a business trip this week. So I don't know that he did a show yesterday. I guess just finish up with a couple of last things that I wanted to show. I shared the Niall Ferguson already. This is a seasonality chart from seasonaltrader.com. Thank you, Jake Bernstein. Weekly seasonals on the S&P 500 over the past 30 years, 1995 to 2025. And I just wanted to note this lull here from February into March. I think that's where we're at right now. I ultimately still think that the liquidity flows are going to support markets through the year. I do see what's going on right now. I am aware of the decline in the markets. I'm on the sidelines in terms of equities, but I'm ultimately looking at it as a buying opportunity, primarily because of these liquidity flows. So that's how I'm seeing it. And I think I'll not be here next week, but the week after, we'll get back to looking at more specific cycles in markets, shorter term cycles, helping to navigate the short term. But I thought it was important that we dug into a big picture, long-term perspective, and also really bring forward this purpose of the Foundation for the Study of Cycles, which is to help us help the world have a knowledge of cycles and to integrate a knowledge of cycles into our policy and personal responses. So thank you, everybody. Don't forget, if you haven't registered yet for our New York City in-person conference, that's coming up in June. We'd really love to see you there. And thank you all for your support for the foundation. And tell a friend to join us next time on Cycles TV. Have a good week, everybody.